Good afternoon, everyone. Thanks for the opportunity to give this address. I believe Hamish Douglas gave it last year, so I've got reasonably big shoes to fill. The difference between Hamish and me is he has about $65 billion more in assets under management. So hopefully we're going to make this interesting for you. So I believe it's the most exciting time to be alive in human history, and also the most exciting time to be an investor in human history. Advances in technology, science and transportation are lifting the vast bulk of the world's population to a higher standard of living. It was only 10 years ago that the first Apple iPhone was released. There should be no doubt that this pocket-sized supercomputer has dramatically changed the world in a decade. You could argue that the combination of the iPhone and Facebook gave us Donald Trump. It's an amazing outcome. Traditional business models are being disrupted while consumers are being empowered. It's a period of rapid change, and your portfolio should reflect the future, not the past. I believe, and the topic of the address today is the best opportunity for investors today. I believe the best opportunity for investors today are where technology and population collide. That is where you find structural growth, where technology and population collide. If you only invest in domestic equities, this is you. You are fishing in a very small pond for a very limited number of species. You may catch a Telstra fish or an AMP fish, but you will not catch a Google fish. If you invest globally, this is you. You are trawling the deep blue ocean for prize catches. However, my comments today are not about Australian equities versus global equities. I've always believed in Australian equities for income, global equities for growth. They do complement each other in a balanced portfolio. To my way of thinking, it's the opportunity cost of not owning global equities that is the issue. It's also the limited opportunity set in Australian equities versus global equities. If you look at the relative sector weights, the ASX 200 is almost over 40% financial and real estate stocks. It really is just another giant play on Australian real estate and Australian mortgages. It's pretty clear to see that Australian residential housing prices are peaking, and the credit super cycle has also peaked. It is also nearly 20% materials, which reflects Australia's natural resource endowment. But in the new world of technology and e-commerce, the ASX 200 is very close to zero weight in a world running nearly a 20% weighting in IT. The US market is 30% and emerging markets are 29% IT or technology, whatever you want to call it. It's a key reason you need global exposure. The fact of the matter is that Domino's Pizza is not a tech stock. If you also think about just the opportunity set, Australian equities represent 3% of the market cap of the global universe versus 97% outside Australia. 99.9% of the world's population lives out of Australia, and the biggest addressable markets are outside of Australia. So when I think about how do we pick a stock, I think the first thing I think about is the size of the addressable market. I believe you buy companies that can deliver compound growth over multiple decades. I call them structural growth stocks. A classic Australian example would be CSL over the last 20 years. The biggest driver of structural growth stocks is, in my view, the size of their addressable market. And the biggest addressable market I can find is Asia, but particularly Asia's rising middle class. This is the classic example of where technology and population growth collide. When I look at Asia, I see 60% of the world's population, 4.5 billion people. There's over 1 million millennials in Asia. I believe they're people slightly younger than me. GDP growth is over double the average of the developed world. There's 1 billion daily average users of Tencent's WeChat and 700 million monthly active smartphone users. But then when I look across at China's middle class, it is already the same size as the entire population of the United States. By 2026, we forecast that the Chinese middle class will be over 500 million people. There is empowerment by mobile data and generic cheap smartphones. Asia is rolling out 4 and 5G networks, and Australia is rolling out a national broadband network. Asia is all about mobile data. They skipped the desktop era, they broadly skipped the laptop computer era, and they are leading the world in e-payments and e-commerce through Tenpay and Alipay. In Asia, your smartphone is your wallet, your sole form of communication, and effectively a shopping mall in your pocket. Of WeChat's 1.1 billion daily users, 55% open the app more than 10 times a day. And you thought your children were heavily into Facebook. The average user spends 220 minutes a day on WeChat. It's fair to say that Tencent controls China's eyeballs. Going back in time, I was a stockbroker, and the biggest thing I believed in was the rise of the Asian middle class. I've always believed that the rise of the Asian middle class was the biggest event of our investing lifetime. Back in the broking days, I was an outspoken bull on Australian resource stocks, forecasting a super cycle in commodity prices that continues to this day. I was also the first broker to back Fortescue Metals Group on the basis that we're seeing a step change up in iron ore demand, but no supply response from the incumbent producers. I'm still waiting for Andrew Forrest to invest in my fund. No offence, Andrew. That was the first leg of Asian growth, fixed asset investment in metals-intense infrastructure projects. The next leg of Asian growth is consumer spending as incomes rise and behaviour westernises. It is a new source of consumer demand that will reprice a wide spectrum of products and services. What started in iron ore and coal a decade ago will eventually affect everything as 4.5 billion people seek and achieve a higher quality of life. This is already happening before your eyes as we watch categories such as baby milk powder, vitamins, fine wine, medical devices and even Hermes handbags being repriced by this new demand factor. In Australia, we've seen huge revenue growth and associated share price gains from companies like A2 Milk, Bellamy's, Blackmores, Treasury Wine Estates, Costa Group and Cochlear, to name a few. Just a small portion of the Asian population discovered Australian milk powder, vitamins, wine and hearing aids, but look at the effect it's had. My view is this now spreads to a variety of different consumer-facing sectors listed here on this slide, many of which would be currently considered commoditised products, just as iron ore was 15 years ago. If you look at the slide, mobile telecommunications and data, which I've referred to previously, is clearly seeing structural demand uplift. There is no turning back now, and I'm of the view of the next decade, industry leader Tencent, which is listed in Hong Kong, will become the most valuable company in the world by market cap as they monetise Asian eyeballs. I think it'll be more valuable than Apple, more valuable than Google, more valuable than Microsoft. I also believe that combined with an increasingly cashless Asian society, that is driving strong demand for e-commerce offerings. It is worth remembering that the two biggest retailers in China, Alibaba and JD, don't have a physical store. Comparing this to the USA, where Walmart still generates 3 times the annual revenue of the fast-growing Amazon, I believe Alibaba will be more valuable than Amazon over the medium term due to its addressable market advantage. That e-commerce growth then drives demand for offshore goods and produce. This may sound somewhat crazy, but I believe what we've seen in milk powder through to premium wine is coming to all agricultural products. I believe a premium price is coming for agricultural products from clean and green provenance. This is good news for Australia and good news for New Zealand. My view is over the next decade, the price of beef, lamb, pork, fish, grain, fruits and fresh vegetables will rise sharply as Asian incomes and associated dietary changes drive a step change in demand. Yes, for my millennial friends, the price of smashed avocado will become prohibitive. But where I see the biggest opportunity is in tourism, and this is relevant to Australia and the entire region. Tourism was where we have our biggest bets in the fund, and it's the biggest structural growth theme I believe in. I believe it captures all of the elements that I think are driving this growth. I believe in the rise of the Chinese tourist, in particular, will be a multi-decade event. China's travel industry, as you can see on the chart there, grew at a compound average growth rate of 21.5% from 2009 to 2016. That is a classic example of what we would describe as structural growth. We are seeing supportive government policies, such as reducing visa restrictions, rising disposable income and an expanding middle class, improved infrastructure, such as China's 220,000 kilometres of high-speed rail network, where, for example, the Shanghai-Beijing line now carries 160 million people per annum, and a growing number of airports and airlines. Again, this is a classic example of where technology meets population. We are seeing an increase in internet and mobile internet services that are also facilitating travel bookings. The best thing about investing globally is you can go straight to the most direct exposure you can get to the given structural growth theme you believe in. In this case, not Star Casino or Sydney Airport, which in my view are highly diluted ways of playing Chinese tourism, but the monopoly airline booking system in China called TravelSky, or stock number 696 Hong Kong. TravelSky, for those of you who don't know, is a GDS booking system which connects airlines, airports, travel agents and passengers. Think of it like a toll road for airports that clips the ticket for every airline passenger in China. Unlike Australia, where Sydney is getting a second airport after 50 years and Melbourne is getting a train line to the airport, China is building civil airports at pace. And this is another example of the law of big numbers. Currently, China has 229 airports. Another 47 are being built by 2020, of which 35 of those have already started. By 2035, there will be over 400 civil airports in China. A classic example of the law of big numbers and big addressable markets facilitating growth. All things being equal, we think TravelSky, which is a mid-cap Hong Kong listed stock, should prove a compound growth stock to this structural growth theme. We forecast TravelSky to grow earnings at 15% per annum for the foreseeable future, yet we can still buy this Hong Kong listed mid-cap at around 18 times forward earnings, which we think is cheap, considering, unlike Australian transport infrastructure stocks, TravelSky has 20% of its market cap in cash and no gearing. So for me, the rise of the Asian consumer and the rise of the Chinese middle class is the biggest investment story of the next 20 years. For mine, it's been the biggest story facing Australia in the region for the last 15 years. Started in resources and it's spreading to a wide variety of sectors. With a global mandate, we can take advantage of that. So in summary, I think the future lies directly to our north. I believe in an Asian future, and I believe in the Asian consumer is the best structural growth theme you can invest in over the next 20 years. So Australian investors have a choice: Tencent or Telstra, Ping An or AMP, TravelSky or Transurban, Alibaba or Woolworths. My view is you don't stand in the way of 4.5 billion people moving in one direction. Join them. Thanks for your time.